Hey there, everybody. Thank you for joining us. My name is Shane. I run the events over at 10 Capital Network, and we have a great presentation today for you on early stage fundraising do's and don'ts with Zamir Shukho from Vibranium.VC. So we're really excited to have him today come on and talk to you. If you have any questions throughout the session, please go ahead and put those in our chat box. We will also have polls at the end of each presentation today, so be sure to answer those as well, and we'll make the follow-ups necessary there. I'm going to bring up our CEO, Hall, and Zamir. I see you already on the screen. Hall, why don't you go ahead and take it away for us today?
Thanks, Shane. My name is Hall Martin. I'm the CEO of 10 Capital. I want to thank everybody for joining today. We have a great presentation from Zamir of Vibranium.VC on the fundraising do's and don'ts. We get this question a lot and appreciate him sharing his insight into this area as well. Please put your questions in the chat box as we go forward, and we'll do our best to answer them at the end of his presentation. And with that, let's go ahead and introduce Zamir. Zamir, thank you for joining us. Can you tell us more about yourself and your fund?
Thanks for having me, Hall, Shane. Good to be here. I actually have the information about the fund on the slide. It might be better to show it to everybody. And I'll talk about it in the end of my presentation. And in the beginning, I'll tell everybody a little bit about myself.
Great. Well, with that, let's go ahead and kick off with your presentation.
So today I want to share a few things to the founders that are watching us because we encounter these conversations almost every day with founders, with entrepreneurs, and we want to make sure that you understand the mentality of a venture investor and how we are thinking and what we're looking for when we look at the deals. This way you are better prepared for the dialogue and for the due diligence process. And let me start off by shortly introducing myself. I'm a serial entrepreneur. I run the Vibranium.VC venture fund as a general partner. Prior to that, for about 10 years, I've been running Global Venture Alliance, and I've built over 10 different companies and organizations throughout my career. My team, we've been working with startups for many, many years, building accelerators, corporate innovation programs, and now we're actively investing, and our fund is located in Bay Area in Menlo Park. Just a quick shot at who I am besides my career. I'm a father of three, happily married. I have three kids and a dog. I like doing different outdoors, sports, yachting, hiking, many activities. And that's one of the reasons why I live now in Bay Area, because it's a beautiful place with great weather and great outdoors. Now, let's start with how investors are thinking, right? So this is something that entrepreneurs are always wondering. And I've highlighted a few things that are important to investors. Of course, first of all, investors are people who made their money by doing, either a business or working, in a large corporation. So they earn their money. They are professionals in what they're doing. And now, because they have an excess amount of money, they're thinking of how they can put that money to work. And one of the channels they can use is venture capital or investing in IT companies, fast-growing innovation teams. So first thing they want to do, of course, is earn money by investing that money into a startup directly or investing that money into a venture fund as a limited partner. Some of those investors already have a portfolio, meaning they have other businesses, other assets that they've invested in, maybe stocks, maybe cryptocurrencies, etc. So they want to diversify by also adding startups to that portfolio, because startups are considered to be a high risk, but also a high return, but it's a long investment. There's less liquidity in that investment. So typically investors would allocate maybe up to 10% of their net worth into a venture, either a fund or a venture portfolio. Some of those investors want to find a strategic asset, something they can be proud of, something they can brag about, because it's not very interesting when you walk around a networking event with other investors to talk about, the apartment complex that you invested in or a yacht that you're building. But it's more exciting to show them a mobile app or something cool and innovative that you've invested in that is affecting millions of people worldwide, etc. So that's something that can be considered a strategic asset they can talk about as well. Then when we discuss self-actualization, a lot of investors, they might be fond of, I don't know, movies or doing different things, but they never had that chance to have that career. Now they see a startup in that field and they're like, hey, I've always wanted to be close to the movie industry, or I've always wanted to be close to large enterprise businesses and things that can help them operate better. So I'm self-actualizing myself through the investment by helping that startup. I'm actually covering some of my dreams that I had and I never had a chance to accomplish. So that's actually like an emotional part of that investment. And of course, finally, again, they want to earn money. This is typically not a charity, though there's a big group of impact investors who, besides earning money, also want to create a large impact, to maybe a third world country or to a certain group of people who have a big problem. But, earning money is eventually a goal as well. Now, there are a few questions that investors typically ask themselves and think about before making an investment decision. Is this a growing market and an interesting growing technology, or this is outdated and very soon it's not going to be interesting to anybody? How fast will this company grow? And in the end of presentation, I'll show you some of the metrics, some of the real numbers that investors worry about and look for. Would this be a good portfolio company to be proud of? I mentioned this before, or this is something that I would just invest in for the returns, and I'm not going to talk about that investment. How trainable, receptive is the team? And we'll speak about the team in a second. And this is about am I just going to put money in, or the company is open enough, the team is open enough to hear my feedback, listen to my advice, accept my help in their development? Because again, self-actualization also goes through that when it comes to investors, by helping the portfolio companies with self-actualize. How will I exit from this business, from this deal? Now, this question is, of course, important when it comes to making the money. Some of the companies and the founders, they don't have a clear exit path, especially in an early stage. So that's another suggestion I would have. Before starting dialogue with investor, you should definitely think about how this business can exit. Is it going to be acquired by a strategic investor, or you try to take it to a public market? There's a few other ways also. So that path should be clear in your presentation when you speak to an investor, so the investor doesn't have to create that exit in his brain or her brain, and they can discuss what you have in mind for the future of the company. And the final one, I would say, it's if this is going to require a lot of my time. And it goes back to the trainability of the team and the level of readiness of the startup and of the team to take this to global market or to success. If investors feel that they have to be doing a lot of training for the team, they have to maybe step in, roll their sleeves up, and actually take an active position in the business, it might not be very interesting, because typically investors have many portfolio companies. And you can imagine a regular angel investor would have 10, 15 companies. A super angel might have over 30, 40 investments. VC fund like Vibranium, we're targeting 30 portfolio companies by the end of our investment cycle. So you can imagine if we need to spend, few hours every week on each one of the companies, that's going to be all of the time that we have, for the 30 companies in the portfolio. So it should be an involvement, right, for an investor in startups life, but not too active and not too much time consuming. This is called a J-curve, a venture capital J-curve. And it's important to understand for founders and for investors, especially those who are not professional, who are just coming into this field. It just identifies how it works, right? So startups attract investment and they have negative EBITDA, they're not profitable. So, this curve keeps going down, and eventually at the bottom of the curve, they start making revenues, right? So first year or 2 years, they have no revenues. They're building the product, they're testing the market, they're finding their perfect customer segment, etc. So then they start making revenues, but they're still not profitable, right? So they're starting to come up, and then eventually, where this blue line crosses the XDC, you can see that they start becoming profitable, and from there you have the growth stage and the harvest stage. The harvest stage is when investors can exit the business. So at least, it will take 4-5 years. In some cases, if investors come in very early, like seed stage, it takes 8, maybe 10 years until investors can exit. So the reason why I'm showing this is that it is a long-term relationship that you are building with an investor. So when you're thinking about where do I find the right investor, etc., I have a special set of questions, by the way, on a separate slide. I'll show you those questions you should be asking investors in order to make sure it's a match. It's a match between you, your values, and your vision for the company, and what investors are thinking about your team and your company as well. Because it's gonna you're gonna stay together for a long time and interact on monthly basis, on quarterly basis with your investors. So it's important to do the right match in the beginning. Now, another question is typically asked: what are investors looking for in an early stage company? Is it the cool product? Is it the technological hype? Right now it's AI everything, or is it a strong team? And I ask this question a lot, and always get different opinions. But since today it's a webinar, I don't see your hands, so I'm gonna skip to the answer right away. Investors are looking for a strong team, especially when it comes to early stage companies, because there's so many things that can go wrong in the beginning. And definitely the company will pivot the business model, maybe change the product, iterate many times, looking for the right way to create value and take that value to the market. But a strong team can do it much better than a weak team with a really good product. And we've seen this a lot throughout our business. Now, let me add this research, which was done by Stanford a few years ago, and our friend Ilyas Bulaev, he's a professor at Stanford. He conducted this research with his team, and as you can see, most of venture investors say that the most important thing in selecting a deal, number one, is the team. Then it goes business model, then it goes product and the size of the market, then the valuation of the company, etc., the fit into the portfolio. But as you can see, majority, 95% of investors say that the team, the strong team, a professional team, is what they're looking for when they are selecting the deal. Now, there are a few things that team should have, right? Number one, a good, strong team should have domain expertise, right? You either had previous businesses in that field, or you work in a corporation in that field, or you're now an expert in that field. You write books about it. You have I don't know, a podcast, a YouTube channel, and you are a speaker at many events. So you should have the domain expertise, right? Being a serial entrepreneur also is a big plus, right? So if you had previous successes or even failures, it's also good, right? So you've already done. You've made all the mistakes in your previous company. Now in this company is going to be okay. Then another feature that would identify a strong leadership is being able to hire very talented people into your team on the early stage, meaning that you can convince talented people to join you while you're not able to pay them high salaries because you're just a startup. But offering them an option in your company, offering them a small equity in your company, but you are convincing them to join you in your dream, in your mission to build this company together. And that's a very good quality. Another good quality for a strong team that we would be looking for is ability to sell to the best out there, to the largest brands out there, to biggest companies, to large governmental structures, etc., that means you can compete and you can, again, convince these large organizations with your expertise that your product is good and is going to solve their problem. Finally, I would say that raising from the best is also a good quality, meaning that you have some top investors, top business angels, well-known VCs in your cap table, and that will help you fundraise more. But that talks about your ability to build the partnership, convince investors about your vision and about the future of the success of the company, and that's why they believe in you and they put money into your company. There's few channels where you could typically find investment, right? Venture capital is a classical channel. That's different funds, different sizes, pre-seed funds, seed funds. Vibranium.VC is a seed fund. They're angel investors, different groups. They typically come a little earlier, before the revenues, idea stage, MVP stage. There's tools like crowdfunding. Usually companies that have some kind of a device, a wearable, or some physical gadget, crowdfunding works very well for them. Or it might be, like an art project or a movie, something that crowdfunding likes to support. Then there are accelerators. It's a good tool. We used to build those. Me and my team will build 42 accelerators. Typically, they have basic investment and a good program with like mentorship and helping the founder, build the company from scratch. And there's different contests. You can get grants from governments. I would definitely suggest to look at those in your early stages, but try not to take too many grants and waste too much time in contests, because you need to build the business, right? You need to go out there and find customers. That's the most important money you can bring into your company. It's the customer money. And of course, you can bootstrap. But again, I would not suggest to bootstrap for too long. What bootstrapping means is you put your own money from, let's say, previous exit, from your savings into your company. It's a good sign that you put your money in the very beginning. That means it gives a sign to investors that you believe in your company and you invested your own money in it. But if you bootstrap for too long, and I'll show you this on this table with the metrics, you might be lacking the speed of growth that venture investors are looking for. And this is at least 3x a year, 300% a year growth. Typically, bootstrap companies grow 1.9 times slower than a venture-backed company. This is statistics from a very fresh report from Zamir. Now, again, you can choose to bootstrap, but don't do it for too long, because once you find the early product market fit, and I would call it having $500,000 in annual revenue is an early product market fit, you want to raise capital. If you have a venture startup, right, scalable IT company, you want to raise venture capital to grow faster rather than just bootstrapping. This is a simple chart that just shows you how venture capital works. I'm not going to spend too much time on this. You probably saw this before, but really quickly, first you got a couple of founders. They have an idea, they work on it. Then they ask somebody, friends, family, to help them out, to give them some money so they can launch a website and start testing the market, etc. So they raise like $15,000. The next thing you know, they go to an angel investor, and they raise maybe $200,000 on the seed. These numbers are a little low. Seed rounds are typically higher, but it just explains to you how things work. One thing to notice about this is the dilution, right? So first you have 100% of your company because just you and your co-founder. Then every time you raise money from, friends and family, from angels, from VCs going forward, you give up part of the equity. And equity is the most expensive thing that you have in your company, right? With IP rights as well together. So you want to make sure that when you are raising, you're raising enough to grow, but you don't over fundraise. I'll talk about this in a second when I'll show you the numbers. You don't want to dilute yourself too much too early, because this might be a red flag for venture investor. Okay. And we'll talk about this. Now, many times accelerators have this problem, and we used to have this problem as well when we built those programs. We teach founders how to pitch, which is good. Pitching well is a good skill. You need it to start the conversation. But it's important to understand that pitch is only the very first step. And let me show you, I call it the tip of the iceberg. Let me show you this picture of how our process looks like in Vibranium and what you will encounter when you start dealing with professional VCs and start going through a due diligence. So there's your pitch. It's 0-0, right? You just, enter some competition or event like this where you can present in front of investors, and investors say, oh, okay, I like these guys, let's talk. Or it's a scout or, an analyst who's watching it, and they catch you on some of these events, and they say, okay, can you fill out an application on our website? And you fill out an application, and this is the part that is visible. Then comes the invisible part of the process, right? First, what we do, right? We look at the application and we say, okay, does this fit our investment profile? And then I'll show you in the very end, I'll show you what our investment profile looks like. Then we have an analyst on stage 2 that looks at everything, with our own methodology. They look at the pitch, at your website, at your, numbers, and then they score you. Then they pass it on to third level, which is an interview with an investment manager. They'll set up an interview, they'll ask a bunch of questions and request some paperwork, maybe a financial model, maybe something else. And then they pass it on to a GP. So I come in on stage 4 and I interview a startup. I have 2-hour conversation with them, over 50 questions, many different questions, starting with the business model, with the team, how you sell, what's your cycle look like, talking about the marketing, the strategy, moving forward, etc., and talking about the deal itself, right? How much are you raising? Who are the other investors in the round, etc. And what is important when we talk about do's and don'ts? First of all, please never, ever lie to your investors during the due diligence process. This is very important. Exaggerating things I can accept to some extent. Everybody's kind of making themselves look a little better. This goes all the way back to our ancient dating techniques, etc. Like we want to present ourselves a little better. That's fine, but please never make up things that don't exist, especially when it comes to numbers, financials, the contracts, etc. Like recently, we had a project that went through all the stages. And when we did due diligence on them, when we did a technical diligence, we went deep, we looked at the product, and it was all pretty much fake, meaning it was a facade and there was nothing in the back. It was like an MVP that didn't really work. Startup at the same time had good revenues because of their consulting business. They had revenues over $2 million annual, which was good for a startup. But eventually they were not yet selling the product itself. So the platform that they were claiming they had was not operational. So please don't do that. That's important because it ruins the relationship and it will never be a deal. And even if it is a deal, if you made some things up and investors put money in you, eventually, and we hear these stories a lot now, where some startups were faking the number of customers, clients, users, etc. Eventually, it will come out, and it's going to be not pretty, because investors might take you to court for that, for misleading and making up information. So that's a no. Please never do that. Second thing you should know and do is you have to be very, very well prepared for the dialogue. Again, pitch is only the beginning. I'll show you certain things here that would be required from you to have, like in your data room, etc. And the questions that we ask are questions about everything, about your team, about your business model, about your financials, about your projections forward, and again, your legal stuff, all the contracts with different customers, all your contracts with your employees, agreements with previous investors. We look at everything when it comes to the due diligence, right? So please be prepared, and I will show you a few things how to prepare better for these meetings, right? For the sake of time, I'll try to speed up. Now, so this is the data room, and folks from this company, they put nice infographics. Yana puts this on LinkedIn, so I help myself to use that with reference to them. This is a very basic that you need to have in your data room. You have to have your company summary. You have to have information about your team, your company documents, your information about your clients, like contracts, pipeline, usage, etc., market research, investment documents, your cap table, other investment documents there. All your legal stuff should be in your data room, your financials, and again, as I mentioned, this is very basic. We would require a few more things in each one of those. If you have like press coverage, etc., put them in there as well. But this has to be ready before you start your first conversation with an investor. So make sure you put together a data room, because it will help you to speed up the process. With each one of the investors, you don't have to resend stuff over the email. You just send them a link, say, hey, this is our data room. Please take a look, and we'll move forward with negotiations. I'll skip this. This is just an explanation of how our financial, technical, and legal due diligence goes, because we have only a few minutes left. But I want to focus on these metrics a little bit. This is stuff that we analyzed. We analyzed over 500 SaaS deals in the US, and we came out with median numbers of startups who were successfully fundraising, what kind of metrics they had, meaning investors like those, investors appreciate those numbers, and investors believe in those kind of companies. So speed of annual revenue growth should be 3x, as I mentioned before, so 300% a year and more for the past 12 months. Annual recurring revenue, if you're a seed startup and you're going to investors like Vibranium to raise, large amounts of money, your revenue should exceed 500K, and that would show your early product market fit. Valuation cap, the median at the moment is around $10 million. Post money, some of them are pre-money, so it's between like 10 and 11, but that's the median number that we saw. Size of the round is typically around 1.5 million. I'm talking about seed round right now. Some of them exceed that number, go up to 2, but again, the more you raise, the more you dilute yourself, right? So you want to make sure you raise enough for you to have maybe 18 to 24 months runway with your plan on spending and plan on hiring more people. But don't try to raise 5 million if you don't need 5 million, okay? It's not going to help you in the early stage when you are still, your valuation cap is still low. And founders' equity before the round should be above 70-75%. And I'll show you this next slide of what it means to have a bad cap table. It's important, and it might be a deal breaker as well. Now, where you should be heading, right? After you raise your seed round, you should be targeting within the next 18 months. You should be trying to get to $3 million in revenue. You should be trying to get to $50 million in your valuation at Series A. So your growth from the previous round should be, in your valuation, should be around 5x. And the capital consumption index, this is something that you don't really hear a lot, but when you are raising $1.5 million, investors like us would expect you to make $3 million in new revenues, meaning $1 invested creates $2 in revenues. So this math is important, because sometimes I see folks raising 2 million and I'm asking them a question, okay, where are you gonna get with that 2 million? To what kind of revenues you plan to get? And they're like, well, with this money, we're gonna get to $1 million in revenue annually. So you're making 50 cents on each dollar. That's a bad capital consumption index, meaning, this is not a very good business. So make sure you figure these things out whenever you do in your financial modeling, and keep those things in mind, especially the last line. Now, I'll go quickly through the bad situation in your cap table. I mentioned this about how much founders should have, the founding team, before the seed round. So this says 80%, but 75 was the median from our research. So you don't dilute more than 20-25% before seed round. You don't want to have one investor having too much control, meaning that one investor has, I don't know, over 25% of the company in the early stage. That's too much control to one single investor. You don't want to have any dead equity, meaning, let's say you had 3 co-founders, then one co-founder decided to go work for a corporation, but they still remain as, I don't know, 10% equity holder. That should be renegotiated, because if they are not helping the company to grow, it doesn't really matter what they did in the past. That equity is very important for you to have as an asset in order to attract more investment in the future. So you want to renegotiate that if somebody's leaving the company. And you don't want to do a zoo of investors. That's sometimes happens when you do a crowdfunding and you don't structure it properly. You don't create a special purpose vehicle, SPV, and you just accept money directly from people, I don't know, with their $5,000 investments and $10,000 investments, and then you have over 100 people on your cap table. I've seen this. That's a bad situation, because you have to report to every investor that you have on your cap table, and reporting to 100+ investors on the seed stage, that's a hard job. And each one of those investors might have questions and comments to you. So you don't want to have that. Now, really quickly, I'll skip through this, but when you are looking for an investor, you want to ask them questions as well. Questions about their focus, questions about their process, questions about their follow-on is important. Like, what is your strategy, Vibranium? Do you follow on? How do you follow on? How often, etc.? What are the criteria for the follow-on? Meaning, do you give more money in the next stage? Governance, do you take board seats, etc.? And what kind of support do you give? Do you help companies? Do you participate? Do you introduce them to your network, etc.? So all of these questions you should be asking your investors in order to make a decision whether to accept or not what they're offering you. Okay, so don't be just on the receiving side of questions. You ask questions as well. And in the end, I'll tell you about Vibranium really quickly. So why do we invest in B2B SaaS? Because the market is great. It's stably growing. It's going to be growing, at least 18% annually. So those technologies are something that we really understand well, because we've been doing corporate innovations for a long time. And we believe that this is a very stable venture market. This is our investment parameters, right? So you want to have at least $40,000 in net monthly recurring revenue, equaling to $500K annually. You remember that number from my previous slide. Your revenue growth should be 300% and higher, coming out to monthly 15% growth at least. Your valuation cap should not exceed 25 million in our case, because that's the cap when you typically would raise your Series A. Those companies who reach that valuation cap are entitled to raise Series A. We focus on B2B SaaS, 4 verticals: productivity software, fintech, sales and marketing, media and information. Now, these are the things that we're not interested in because either we don't have an expertise, or we believe that this is not our interest, like pharma, biotech, medtech, anything in crypto. We don't do hardware. And there are some things that we don't do because of our moral standards. We don't invest in companies related to alcohol, tobacco, legalized drugs, adult industry, gambling, weapons, or if you're non-IT. So those are the things that we don't invest in, because we want to be proud of our portfolio companies. And that's okay. I mean, some investors do. It's just our choice. Seed stage is is our sweet spot. Typically no bridge rounds. Company should not be older than 3 years old. This was the question about the bootstrapping that I mentioned before. So should not be too old. I mean, we can accept company 4 years old, maybe 5 years old, but again, then there will be questions. Why are you 5 years old and you're raising your seed stage only now, right? So that means you had a slow growth. We want to have teams with core expertise in the area. If they're serial entrepreneurs, it's great. Of course, they should have an ambition to grow to at least $100 million in annual revenue in 5 years, recurring revenue, right? And we typically invest up to $500,000 in our first round and up to $1.5 million in our follow-on rounds. Now, just to finalize what I said, fundraising is a tough job. It's a full-time job for the founder. So you will start like this, and then 6 months later, you're still pitching to VCs, and you're tired, and you heard so many no's. But I want to encourage you not to give up. You will hear 49 no's and 1 yes. In order to raise your seed round, I also always say you need to have a list of at least 100 plus warm, investors that you talk to, and then you will convert 4, 5, 6 of them into your seed round, which is the typical statistics. But just don't give up. Continue talking to them, accept no and accept feedback to become better, to become more investable. I try to give open feedback to startups just to help them, to be more investable, even if we say no. Most likely we would give a bigger feedback if we say no to an investment. And I appreciate that you came today to listen to me. These are my credentials. If you want to connect on LinkedIn, you can scan the code, or you can find me with my name. Thank you so much for listening. I'm happy to answer some questions.
Thank you, Zamir. We had some great questions come through, and it was a really great presentation as well. The first question is, can you discuss some exit strategies for a product sales company that may not want to go public? How else could they exit?
So I would say out of 10 companies that exit, 9 companies are being acquired. So you want to start thinking about your acquisition early. You want to target or understand what companies in your market are acquiring teams, acquiring other companies in different stages. You don't want to sell too early. You want to grow your business maybe to, I don't know, 80, 100, $200 million valuation before you sell it. But that would be your typical exit. It's actually M&A is a more typical rather than taking it public.
Great. Next question is, for a startup company where the founder is the only employee, would a potential investor take comfort in a slide showing the team that has been assembled and is ready to go pending funding, such as the accountant, attorney, et cetera?
Sometimes we do, but as I mentioned, one of the core qualities of a great founder, of a potential champion, is an ability to convince people to join them before there is money. So they would believe in the mission of the company. They would, go and maybe part-time at least help the startup to do something to get a little bit of traction, build some kind of a first prototype of the product. So trying to convincing those people is a good sign for investors that you are a potential future champion. But if you can't convince them unless you have the money, it might be a red flag.
Great. Next question is, what % of founders split with differences later on?
I would say maybe around a third of all the companies, especially when the hardships strike. Typically it happens, it's called a death valley, right? When you have your early adopters and you have your first sales, and then there is a long stretch before you get to your mass market. That's where majority of startups die, 95% of them. And one of the big reasons, if you look at the top 10 reasons why startups fail, the first reason would be nobody cares about the product. So there's no product market fit. Nobody wants to buy it. But one of the top reasons is the conflict between the founders, or conflict between the founders and the investor. So it's a very common thing that happens. So you might want to very carefully consider who you go in with in the business, because again, it's a long-term, it's a 10-year commitment at least. So you want to make sure that people that you are with are solid, that they will not back down, that they will be with you in good times and bad times.
Great. Next question, can you talk about safe versus convertible debt at the seed stage? How amenable are VCs to safe investments, and at what point should founders discuss this with the VC?
So I had several posts on the differences between the SAFE and the convertible debt. SAFE was created to speed up the process by YC. A lot of times it does not cover certain ground that investors appreciate in their rights. So basically SAFE takes away some rights from investors just for the purpose of the speed to close the deal faster. It's good for accelerators, not very good for professional VCs. Right now, I can see the backlash. I can see that more investors start saying, hey, we don't really like SAFE. Let's do the convertible loan agreement, something like that, because it's a little different in the structure of the deal. And then, investors feel that they are more protected if it's a convertible loan rather than a SAFE, because with SAFE, they have a lot less rights. But again, if you're very hot and you have an amazing startup and technology and you're oversubscribed, then you dictate the rules.
Great. Next question is, why Combinator insists on at least 2 founders to fund a company? Do you have such a rule?
We don't have such a rule, but I understand why YC is doing that. There was a research done by Silicon Valley Bank back in time, and I used that slide in one of my presentations, where the 2 co-founders is the most likely to be invested type of a startup. There's like stats that show almost half of the funded companies had 2 co-founders. On the second place, there was 3 co-founders. Third place, there was 1 co-founder, and 4 and more co-founders is the least likely to be funded. So investors look at those stats because, we are in the market, right? We have to align with everybody else out there. So we want to make sure that if we invest in something, there's other investors that would believe in the same thing, because it's a game where there's many, right? Investors coming. So yeah, 2 co-founders is the more likely to be invested company.
Do you consider D2C brands too?
Again, it depends, but because we are a B2B SaaS, we want to invest in software. We don't invest in retail. I know that D2C is picking up right now. I'm watching the markets, but it all depends on what kind of a business model you have. If you have a software next to your D2C brand, and the software eventually will become the largest part of your revenues, we can consider it.
Great. What are your thoughts on crowdfunding like the WeFunder and the Start Engines? I
think crowdfunding is great for products that have physical, it's either a wearable or a gadget or something that people can relate to. A lot of times crowdfunding just helps you prove that there is market for this product. Basically, you're collecting pre-orders, right? And then you can come to the investor, say, hey, I have 1,000 people backing me up on the crowdfunding, so there is an interest for this product. Give me, an investment. So you come to an investor with some feedback from the market, basically people backing you up with their money, which is good. But in terms of IT, it doesn't really work with IT companies like that.
Great. You showed a slide that mentioned option pool. Who is in the option pool?
Typically, those are your core employees, those that you want to make sure that stick with you for a long time, like your first hires, right? The typical option pool is somewhere around 10%. And whenever you give up options, you have a vesting period. The classical vesting period is around 4 years, meaning that you hire somebody and you say, okay, I will give you 2% of the company. The first year, you get 0.5%. The second year you stay with us, you get another 0.5%, and so on. So this way you motivate these talented people to stick with you, to work with you, to build this company together, because a startup is a team sport, right? I mentioned this before. And the difference, by the way, this is a good question for another reason. The difference between Silicon Valley and everything else, the difference between venture market and venture startups and everything else, this model was created here. The options, the little equities that were giving to talented people when there was no money was created here, and it really attracted a lot of talent to the Valley back in '60s, and that's why we see all these amazing companies here.
Great. You mentioned valuation in the current market. Can you briefly go over the valuations you are seeing at seed round versus a year ago?
Honestly, seed round was not affected too much. I saw a recent research that said only 5% drop in the valuation. So I would still say the median valuation of a seed company is around $10 million, like 10.2, 10.8. million, it was not affected. But the further you go, and I had a LinkedIn post about it, the further you go to the alphabet, you know, C, D, etc., the heavier they got hit with the drop in valuation, because their closeness to the public market. So the closer the company is to the public market, the more affected it was. So on the seed stage, not much effect at the same at this time.
I think we're at the end of our time here, Zamir. Thank you so much for a great presentation and great answers, and for the audience, great questions. Appreciate that as well. Appreciate having you today. If anybody would like to learn more about Vibranium.VC, go ahead and click on the poll that's currently running now. I'd be glad to connect you with Zamir and his team there at Vibranium. Thank you so much, Zamir. Appreciate your time. And with that, we'll move to our first presenters. We have Howard Bates and Mike Seidel of Pivot CX. Howard, Mike, if you go ahead and launch your slides, we'll go and kick off with your presentation.
We on, Mike?
All right.
Okay, we're pulling him up.
All right. Zamir, thank you so much. Every time I see you present, I learn something from you. Thanks a lot, Hall, for having us. We are Howard and Mike with Pivot CX, and we are we're bringing proven technology and processes to accelerate, automate, and orchestrate communications. We're making life easier for recruiters, and more importantly, we're setting the stage so they can automate and leverage AI in the future. A little bit about our team. We've started a few companies. I think this is my 5th startup and 2nd exit. Howard's got me a little bit. He's had 1 company go public already. And then our third leadership team member, David Bernstein's a longtime industry veteran who is heading up our partnerships. And Howard, you might want to share just a little bit about your big exit.
Well, yeah, I mean, just real quickly. So I'm going to echo what Zamir said. I think a lot of this is persistent, sticking with things. And I guess the first company that I was really fortunate enough to be part of, I started it in my basement with a second mortgage on my house that my wife and I probably didn't really understand what we were even doing. But that grew into be actually a public company, and still is a public entity. So we've got a lot of expertise. I think as Zamir will kind of follow that model, we think we've got a domain expertise within our team that it really understands the problems within this industry and space.
And you know, one of the things that we've managed to do is attract a great team of advisors around our company. We have a gentleman who's the product leader at Genesis. We have George Larock, who's an absolute expert on the work tech sector. Craig Fisher just joined our board of advisors, and he is the expert on candidate experience. And then William Tincup, who's the thought leader, really the foremost thought leader in the HR tech space, among others. So what's really special about Pivot CX? Well, we have absolutely great product market fit. We're in a position where we're raising money to scale the company and focus on sales and marketing growth. We've landed some fantastic clients like Kelly Services, Great Clips, Community Healthcare, 7-Step. They are the 9th largest recruiting process outsourcer in the world. Kelly is number 2. So there's HTI and others. We're actually building a new category of software in the work tech space called the Communication Hub. And we'll talk a little bit about that in a moment. You know, I've went through our leadership team and advisors. We have a little bit of experience, and we own all of our IP. It's our own software, top to bottom. So the problem that we work on is slow and ineffective communication. So I think everybody on this call probably has applied for a job and just never heard anything back from the recruiter. Maybe somebody's went to HR and asked a question about benefits and never heard back. It's not because HR people and recruiters don't like you. It's because they're actually really, really, really busy. And what we've learned as we built Pivot CX is that most recruiters, most HR people have to log into 21 different systems every day just to do their job. Those systems, a lot of times, are older legacy systems that don't enable them to communicate with people on the right channel. So we're trying to text the next great forklift driver, or we're trying to send an email to the next great forklift driver, and maybe we're sending text messages to doctors and oncologists. We also, and the results of that is really just a poor candidate experience. And then as you go through and look at most companies, they spend about 50% more on recruitment advertising than they have to, because their candidate experience, because their communication with candidates is so poor. On the employment side, poor communication with employees results in turnover and can really sap an enterprise out of its ability to succeed. Just a quick look at our market. We're in a pretty large space. The thing that gets me excited about it, and I think gets Howard excited about it, there are two things. One is our CAGR is 20% through 2030, so we're projected to grow quite a bit. And for our particular segment, our SOM is big enough that we actually don't have to get 100% of the pie to be successful. We can go out there and compete inside that 209 million. And if we, can grab a majority of it, we're going to have a great successful company.
And there's one other element there. We've only very conservatively used a 15% adoption rate within the TAM. So there's a lot of room for the market to grow aside from just the 20% CAGR that's growing there.
So our product is the communications hub for recruiting and HR. We plug into systems of record like applicant tracking systems and HRISs, and we enable communication across all channels. So we do email, voice, video, web, and text. We enable both human-to-human communication, and we make sure everybody can talk to candidates on the right channel. So if we're talking to those forklift drivers, we can text them. If we're talking to the oncologist, we can email them. We dramatically improve candidate experience. We give back recruiters and HR people about a third of their day. And then when you look at what we're really giving these teams, we give them the ability to personalize at scale in a way they couldn't before. And that leads to some really great solutions.
And I think it's important to mention that this is a SaaS-based communication platform. So I'm not sure we hit that, but it's clearly SaaS.
So we do have 3 LLM generative AI features coming to market. We are going to be leveraging the new generation of smart translation technology, and that'll enable our HR folks and recruiters to maybe communicate with people that don't speak the same language that they do. And then we'll be bringing 2 different co-pilot tools to market. And both of these tools are really designed to recommend the right answer and help a recruiter give the right answer to a candidate, help an HR person know what the right answer is based on their internal information. So here's a little bit about what some of the industry experts say, and I'm not going to go through and read everything other than point out there's one common thread among all of these, and that's that we're, almost everybody says this is where things are going. This is the future for HR and recruiting. We do have some competition. We compete with a lot of solutions that are really single-use kind of tools. So when you look at a Pivot CX, we're enabling communication across voice, video, web, and text. Most of our competitors are going to enable just one of those workflows. So you'll see, SenseHQ, Paradox, some of these other companies. We actually support 4 times more communication channels. We integrate with more systems of record. So we integrate with 128 different ATSs and HRISs. That's 5 times more than our nearest competitor. We built an open API so that our channel and our partners can build solutions on top of our product. Our customers can build right on top of it, making our product more sticky. And that's led to some pretty good success. I think Howard mentioned our business model is B2B SaaS. Well, here's a look at our pricing and how we sell. We have 2 different levels, and the prices you see on the screen are what we usually propose our deals at. And what's been fun for me as a former sales guy is I really enjoyed watching customers when they buy, spend more than what the list price is. And that's because we've got some pretty good strategic upsells. And we've really done a lot of work over the last 2 years to figure out how do we get this package so that it's easy to buy, and we have some elevators in the pricing. And here's a look at the features that come with our gold package. Our go-to-market strategy is pretty simple. About a year ago, we brought in David Bernstein, who's our EVP of partnerships, and made an investment into the partner channel. And about half of our business comes from the partner channel, a little over half does. The other 45% we want to come from direct sales. Here's a quick look at who our partners are, and it's a mix of consultants, recruitment ad agencies, RPOs, recruitment process outsourcers, and other work tech solutions. Just a quick look at our pipeline, and if you've seen us pitch before, there are some changes here. Most of our business is coming from the pipeline side of it, and a lot of why we're raising money is we want to focus on the direct sales side of this business. We want to grow that direct pipeline and we need to make some hires to do so. As you look at our pipeline and you look at what's developing, we've landed some pretty good logos, and we've got some great, some great things in the pipeline. Here's a quick look at 4 of our bigger customers, more successful customers. Community Health Network, largest employer in the state of Indiana, about 38,000 employees. Everybody that gets hired by Community goes through our software. They've been with us for a year, and they just renewed. They actually plussed up about 21%. So we started 56K, now we're at 70K. Kelly Services, they are the second largest RPO and BPO in the world, and we knocked a competitor out, and we are just in the process of expanding that one to go beyond what we're doing. But we actually send text alerts to all of their translators and let them know what time their shift is. It's actually cut their absentee rate in half. Great Clips, 4,500 stores, over 700 franchisees. They hired us to re-engage all of their existing candidates in their CRM system, and we were able, they wanted us to deliver 2,000 qualified stylists to their franchise owners. Well, in about 11 months, we delivered 5,322. And so we think that one's probably going to expand. 7 Steps are a really exciting one. It is the 10th largest RPO in the world. And we're really excited about this one because they came to us just a few months ago, and we've been so successful with them that they're now offering our product as one of their service offerings to their clients. Now I'm going to turn it over to Howard, I think, for the important part here.
Well, I'm not sure this is the most important, but it's certainly relevant. So if we look at our platform and we kind of look at Zamir's model, you can see, we've really grown platform revenues quite a bit. The growth, I think Q1 over Q1 of last year was 117%. It's a very important metric. One that I really like right now that I think is very relevant and would hopefully relate to potential investors that are out there is our really efficient CAC payback ratio. So this is basically saying that within every 2 to 3 months, we're paying back the investment that it took to get that customer. One other one that everybody always wants to look at is gross margin. We're still a little bit subscale, but it's still a good number. And last month, we actually saw an uptick in that to the mid 70s, which is a really nice improvement on gross margins. Okay, so where are we? What are we trying to do here? So basically, I'm really happy to say that we hit the mid mark or the median of what Zamir just brought up, and we're in basically a seed round here. We're raising $1.5 million. We're really excited because we think that money is primarily going to go to all business development and demand generation, with a goal by Q1 of 2024 of getting to 200K of MRR versus our 72K right now. I'm also going to say this one. So in comparison, I think this is a potential bargain for investors. With this kind of revenue, we're talking about a pre-money valuation of $6 million, post-money 7.5, and we already have a lead investor, Elevate Ventures, here in Indiana, that's committed $500,000. So we're happy about that. There are a couple other things that may be relevant to investors. One, we do have our data room up and available for folks as well. Elevate Ventures is more than willing to share their due diligence, and we are in the process, based on feedback from many of the VCs and folks that we've talked to. So we're in the process of completing our LLC, Delaware LLC to Delaware C Corporation conversion. That should be completed by the end of next week. So we're trying to make it very efficient for people to consider an investment. We'll move on to some of the exit landscape information. So I'm going to share this with you. I can't really give a name, but I just do want you guys to know there's a lot of activity going on in this space right now. And as a matter of fact, I'll share with you, we received a letter of intent this week to purchase the whole company for a number that's actually exceeding what our pre-money valuation is. So a lot of consolidation, a lot of activity, and a lot of potential folks that could, in the 3 to 5 years, look at us and say, we'd be a good acquisition fit and a monetization point for our investors.
And with that, Hall, we'll turn it over to you for questions.
Great. Thank you guys for a great presentation. Anybody in the audience have a question, please go ahead and put it in the chat box. Zamir, what's your first question to kick off the discussion here?
Well, I know the project, so good to see you, Howard, Mike. We've looked at the project recently. I mean, we just had several calls with the team, and I'm enjoying what I'm seeing, that there's, things are changing and moving forward. One of the things I would probably ask is about the product itself. I remember we spoke about that these larger companies that you are outlining as your enterprise customers that are requiring quite a lot of customization. They want to build some additional features, etc. So how are you dealing with that demand right now, and what is your plan moving forward? Like how flexible the product will be in the future?
No, Zamir, we've actually made our software now end user customizable. So there's actually a new tool in our product that you didn't even see. But it allows customers to build their own campaigns and design their own workflows inside of our product, so that they don't necessarily have to hire a consultant every time they want to re-engineer something. And our integration story is pretty good, where it's just off the shelf with almost every major ATS, CRM, and HRIS. So did that answer your question?
Yeah. Finally, I just want to say that we like Pivot CX, and we gave the team some feedback. They're working on, Howard mentioned that creating an C Corp rather than an LLC, because investors like C Corps better. And there's few minor things that they're working on. So I'm waiting for you to come back to us, right, with those changes.
That's good. Thanks, Zamir.
Thank you.
Great. Thanks, guys. Thanks for a good presentation. And now we'll move on to our next one. We have Michael Hendricks of Alcanza. Michael, if you'd like to go ahead and load up your slides and kick off when you're ready.
All right, so I'm Michael Hendricks. I am the founder and CEO of Alcanza. Alcanza is a vertical SaaS play that is looking to make more efficient law firms in their processing of immigration, also providing a D2C service directly to the consumer to be able to purchase, which doesn't exist at this time. And we're making immigration more accessible. The thing is that if you went and put a bunch of people into a room and you asked them, or you told them to describe immigration in a word or two, they would say all kinds of things, probably difficulty, expense, customer frustration, attorney frustration, delays. And so they wouldn't be able to agree on one specific issue. But what they would be able to agree on is that there is a major problem in the system. And I'm sorry, jumped. So we see that there's a lack of digital systems, language barriers, expensive attorneys, immigration complexities, and then obviously everything has to be done in English, when a lot of times that's not people's first language. So we are a vertical SaaS with artificial intelligence, looking to assist immigrants and their attorneys in applying for immigration benefits. Very similar to how TurboTax simplified and put logic inside of taxes. We do that for the immigration. So immigration is very similar to taxes in that it is an administrative legal process that does not require an attorney to apply. So we are multilingual, AI-driven, and affordable. And we have various ways that we help people. So for the D2C, it's find, fill, file. So find out if you're eligible, fill the process in the forms, the workflows that we have built out. And then it goes through an approval process with your human guide in the AI. And then an attorney reviews it for most packages, so that you have the confidence, and then you print and file. We are hoping that soon we can force immigration into creating APIs so that we can have digital filing. They have not done that yet. We also have various ways that the law firms can use it. And we have like a B2B full service where the person throws up their shingle, they're ready to start working, but they don't necessarily want to staff out completely. So instead of staffing out, they can just come to us and say, hey, I got this new case. They pay us our fee. We do the case for them with the client. We hand it back to the attorney. The attorney gets it signed and reviewed and then sends it out. Or they can just use our system, which creates efficiencies. What we're seeing is that this will reduce the amount of legal assistance inside of a law firm significantly. And that's a subscription based, and they can also do the affiliate process, which is not on this slide, where they just find people that come in that are eligible but can't afford an attorney, and so they send them our way and they get paid a percentage of that. We're making a difference with D2C. Like I said, multilingual, big deal. We have it available in every major language in the world, over 125 at this point. It does have human guides, but the idea is we have an LLM that we're training currently on Llama 2. It is a commercially licensed product that we're able to use, and we will have in production within the next few weeks. I am personally building that. I have been an attorney for almost 10 years, been in the immigration space for 12. I've written books on the subject and have actually been practicing for that long. We also created the system to be an affordable service. So it's about 20 to 25% of what you're usually going to pay for an attorney. And it comes, like I said, with an attorney review. We also have document translation services and specialized language learning that comes with it. We're making an impact for B2B. And like I said, primarily by reducing, or rather increasing their efficiencies by reducing their costs, primarily for legal assistance. And we offer other services, like I said, affiliate services and so on, also language training, ESL classes and so on. So the total beachhead markets, the total market is 10.5 billion a year, and that's just in the US. That doesn't include people who are applying from abroad. There are 11 million, I should say undocumented people in the United States. I have documented, I apologize. 14 million lawful permanent residents, 9 of which are eligible for citizenship, 500,000 green card approvals a year inside the US, 25,000 fiancés. You can see those numbers. I know that we don't have a ton of time, so I'll let you read them if you would like. But there is a big market share available in the US and abroad. The D2C and B2B beachhead market is over 170 customers so far have been served. Really, the market is under 40. Minimum high school education up through college, because they need to have a little bit of understanding about technology. Median income of about 40, and that's because these are people who can't quite save enough to pay $10,000 to an attorney. For the B2B market, immigration law firms, less than 10 employees, annual revenues between 500 and $1 million, because that'll make a huge impact if we can reduce their labor costs by even 2 legal assistants. You're talking about reducing their cost by $100,000 a year. And people who are newly entering into the legal market, practitioners, that is. The business model primarily focuses on the social aspects, so social media, websites, of course. I have become one of the top legal influencers in the country. I have live programs on the radio and on social media that I do. Trade groups, obviously, want to bring them in. There are large organizations like Americans for Prosperity and all these different groups that help immigrants in the form through their groups Libre and stuff like that. They're using our products in the form of the language learning, and soon we'll be using the product in the form of an affiliate for actually doing immigration processes. The biggest one right now is our affiliates. We have just now brokered with a group of what are called notarios. So these are people who are non-licensed practitioners of immigration, which is technically in a gray area of the legal space. And so we're able to bring them out of the cold into the light of being able to do their processes. They already have a direct access. They do this every day. They service immigrants, and their processes every day. So they're able to, they have a natural product fit with us and bringing their clients in. B2B systems, obviously, and the future government contracts is actually the most exciting for anybody looking to invest. And I can talk a little bit about that here in a little bit. And we're able to convert people by the natural system, right? Bringing them in through affiliates and other people who are already doing this, but also by having a simple to use system that's available in over 100 languages, accessible. You can get it on anything, computers, tablets. Here in about 2 months, we'll have a native app where you'll be able to access your timeframes, how your process is ongoing, is moving forward. You'll also be able to access our AI and ask it questions. But it's not, well, I'll get there. I almost jumped myself. It's also affordable and it's guided, and then we can wash, rinse, and repeat. So product lines primarily for the D2C, obviously they're the different immigrant-based systems and non-immigrant visa applications, document translations, and the vault. The vault I haven't even mentioned yet, but this is a subscription-based for D2C where they're able to maintain all their necessary and important documentation at rest, encrypted in our vault, and will have access to it. And that's a monthly subscription that they'll be paying as low as $10 a month. and they'll be able to add other things, their birth certificates, they'll have their immigration paperwork, they'll be able to add a copy of their green card just in case there's a fire or somebody steals their wallet. It helps them be able to keep fluid their situation. B2B law practice platforms, subscriptions, learning, language learning, document translation, and obviously full service. And then over here on the affiliate side, educational visas, because we're going to be working with universities. This is one of the products that we're working on right now, or projects rather, that we're working on, is getting in and helping the educational locations, these different groups, the enterprises, to be able to streamline their processes. Direct sales via affiliates, obviously ESL, EFN, which is English for naturalization specifically, visitor visa, training offices in foreign countries, and so on. Competition right now, they're not really in our same, they're relatively in our same sphere, but they're not in our direct sphere. Boundless does not have any AI. They don't have, neither one of them have any type of AI or any native app, which if you know how the world works, many countries around the world leaped over the personal computer and went directly to the phone. And they require, or it's better used through an app on your phone. And there's a lot of other deficiencies, but you can see they are in the space doing applications without running through a law firm. We have just found out, actually, I just found out within the last few days, there Arizona and Utah have what's called alternative legal organizations, which allow you to provide legal advice directly to a consumer, even if you act like an in-house counsel. So it's non-law firms that can provide legal advice directly to consumers if it's ancillary to the product that you're selling. So this shows you a little bit about how it works with the different pros and cons, and Alcanza meets all of those. We do have a pretty good team. I am the executive, the CEO. Actually, this is my brother. He has been a COO for different companies for many years, over 20 years doing that. He owns his own company, but he is my fractional COO. I have a trainer, my guide, that is the human guide currently, and she's worked for me in immigration for 10 years. Robbie Vera is our senior sale, and he is actually pushing. He currently works for us, but is probably going to take the position of COO if negotiations go correctly. And he has been a CEO for various companies, not startups, but companies that were going from their small nucleus and expanding into other states and expanding their opportunities. A tech team, my fractional CTO, Nathan Martin, he's actually the brain behind building what I created in my head. He actually was able to put in technology, and his partner is Michael Maestas. Our marketing team, and we have some advisors. Right now, I only have Mr. Crowell there, but we have some other advisors too that we can add in. So the current ask right now is 1 million. We're at a $4 million pre-money safe note. We want to use this to increase the opportunity for the AI, marketing and strategy, native application, of course, multilingual. And I have all these things already in play. This money is just going to help us push them forward more quickly. Kind of like you were saying, Zamir, in bootstrapping, I have funded everything. I do have a small amount of family and friends who are investors so far, but for the most part, I've just funded everything. And so now it's time to scale. I don't have on here what we're at, but we are currently projected to do 20,000 this month. We have been growing approximately 30 to 50% month over month for the last several months. The company was created, organized in Delaware as a C Corp in October of 2021. But we've been working on perfecting the system, so it hasn't been actually in the market until approximately the mid part of 2022. And so now we're at a revenue stage where we're actually bringing in with a good team. Lastly, I would like to say the AI that we're working on is not just a generative AI. It's a deterministic. It's going to take time to get there, but what its idea behind this AI is that it'll work as a guide that will actually tell you what you need to do next in your application process. And this will allow us to, the big part is get the government contract, where eventually the idea is to build it. Speaking of exits, to build it. There are a couple places like Lidos that do tax forms already for the IRS. So they're natural fits. Intuit already does things because they have TurboTax and other things. They already do things similar to this. They would be a natural fit to purchase. But I think more likely would be getting a contract with the U.S. government. The immigration system is broken. They're trying to work and build new technology off of legacy systems. And as we all know, that doesn't work very well. It doesn't connect. So being able to get a contract with them where we actually help process all of the applications, we could reduce their time by at least one order of magnitude, if not more, and decrease the cost of human resource drastically for that service. The Department of Homeland Security, their use of the Department of Homeland Security's USCIS, CBP, and then the Department of State's use of personnel in the consulates. So I know I said all that stuff very quickly. Now I'm open for questions.
Great. Thanks, Michael. Zamir, what's your first question?
Do you work only with the US?
I'm sorry.
Can you hear me? Hello?
Go again, Zamir.
Yeah.
I apologize.
Do you only work with immigration into US or other countries?
So we don't currently have availability for immigrating to other countries, but that is a natural expansion. That is one of the biggest things that I've looked at for the future, is the natural expansion of opening up to where people can immigrate from one country to another country, not just to the US. But currently it is the US system.
Okay, and what is the largest customer base right now? Which countries are most interested in your technology?
So the technology that we're currently most Spanish-speaking countries. And the reason is because I speak multiple languages. I speak 5, so my influence ability stretches there. But we are working on strategic partnerships with folks in places like India and China and the Middle East in order to be able to develop more need and desire. There's a lot of need, but actual use.
And the last question from me would be, where do you see an exit out of such a business? Who would be the buyer of this company in the future?
So Leidos is one of the big ones because they do currently do the IRS processing. So since the tax forms are very similar in the way they're broken down to the immigration forms, they would be a natural fit. Obviously, TurboTax already does taxes does the process for taxes direct to the consumer. So they would be a natural fit. But it could be an IPO in the future, especially if there's a large government contract that comes out.
Thanks, Zamir. I appreciate that. Michael, thank you so much for your presentation today as well. I want to thank you guys for joining us, and we'll see you guys next time. Have a good one.